Welcome back. Bank Canada expected to deliver its second interest rate announcement of 2024 on Wednesday. And for more on that and what to expect, we're joined by Philip Petursson, Chief Investment Strategist at IG Wealth Management. Thanks for joining us on your Sunday. So what do you expect on Wednesday? Staying pat or cutting?
Well, largely the Bank of Canada is expected to stand pat. They're not expected to cut interest rates in April, although they could. There's certainly enough evidence with inflation as well as with the labor market for them to go ahead and cut. But all expectations are for June to be the first cut this year.
And so what could spur potentially an early cut right now?
Well, we've seen in the past the Bank of Canada has surprised with what they've called an emergency rate cut. We saw this in 2015 when oil prices were falling and it was impacting the Canadian economy. And this go around, we have a weaker economic environment in Canada right now. We have unemployment that has nudged up to 6.1%, so the highest that we've seen in about 7 years. And we have inflation within the Bank of Canada's target, which is 2% plus or minus 1. So everything on paper suggests that the Bank of Canada can cut. It seems that they're a little bit more hesitant and perhaps waiting for the U.S. to take the lead on it.
And so, besides waiting for the U.S. to lead on that and potentially make their own cuts, are they potentially also thinking that, if they do, have a rate cut, especially with homes, people start flooding the market again and potentially raising home prices, making them even more unaffordable? Is that something that they're trying to balance here?
It certainly could be. I mean, the Bank of Canada has spoken about the housing market in Canada in the past, and that could be a concern that any rate relief for prospective home buyers will just drive up home prices. The other side of it is that rate cuts could drive the loonie lower, which could be inflationary down the road. So they're trying to balance the impact against a weaker Canadian dollar and a weaker economy and lower inflation.
How does that work? So if they cut rates, the loonie goes down. How does that work?
Right, exactly. So one of the drivers of the exchange rate between Canada and the United States is the difference in interest rates between Canada and the United States. Right now, our overnight rate's at 5%. The U.S. equivalent is 5.5%. If the Bank of Canada cuts ahead of the U.S. Federal Reserve, that will lower our interest rates further, which is drawing capital from fixed income investors out of Canada into the United States, pushing the loonie lower, pushing the U.S. dollar on a relative basis higher.
I see. Okay, so that would also make sense of why they would probably want to wait for the U.S. to make a move then, I guess. And
exactly, because it could drive inflation as, when you think the majority of our imports are done in U.S. dollars.
I see. So let's say, hypothetically, if they do make their first cut in June, will it be a monthly thing after that if they're going to be cuts, kind of like the way they were increasing rates, or do you see them spreading this out for the rest of the year and a half, 2 years?
Yeah, our expectation is that once they start cutting, they'll probably be cutting on a regular basis. So June, maybe not every single meeting, but I would say between now and the end of the year, we think that we could see anywhere between 75 basis points to 100 basis points of rate relief on the overnight rate.
Now, this is something that, talked about in our newsroom, people who, have some, they bought their home, they have a mortgage, I don't know if they paid it off or not, but, people who are up for renewal, what should they be doing? What should their strategy be as we head into the next couple of months with some uncertainty, but kind of an idea that the rates could be coming potentially in June?
Well, and this is the real challenge that I think homeowners have, especially those that are renewing. Our math works out that anyone that's renewing a 5-year term today from the expiring 5-year term is paying 75% more in interest costs. By June, regardless of whether the Bank of Canada cuts or not, that could be double. So, we're looking for some type of rate relief for the consumer. I would say anyone looking to renew with the idea that the Bank of Canada will be cutting, and once they start cutting, they're going to continue to cut probably well into 2025. So, I don't know if I would be aggressive with locking in another 5-year term. We might want to look a little bit shorter term and take advantage of a interest rate environment that's more favorable, say, in 2 years' time from where we are today.
All right. People taking notes, no doubt. Philip Petursson, Chief Investment Strategist at IG Wealth Management. Thank you very much. Enjoy the rest of your weekend.
You too. Thank you.
Of course.